How confident are you can get to 210 million then, given the challenges around Boeing?
Ryanair beat expectations for its latest earnings report, but Europe's largest low-cost carrier cut its passenger traffic goals for the year, blaming Boeing's 737 production delays.
Ryanair is threatening to cancel a $30 billion deal with Boeing, and it could shake the global aviation industry. With Chinese competition rising, trade tensions escalating, and Boeing under pressure, this isn't just a broken contract. It's a potential tipping point. The Irish low-cost giant is publicly considering walking away from one of the biggest aircraft deals in aviation history, up to 300 Boeing 737 MAX jets. The list price of each plane is around $110 million, though bulk discounts typically slash that significantly. Even with reductions, the deal's value still tops $30 billion. The timing couldn't be worse for Boeing. The company is still recovering from the 737 MAX crisis, years of safety concerns, and pandemic-related disruptions. Losing a major customer like Ryanair would not only hurt financially, it could rattle investor confidence, derail production plans, and squeeze Boeing's already stressed supply chain. Ryanair's threat isn't totally unexpected. CEO Michael O'Leary is known for being aggressive in negotiations and laser-focused on costs. He's clashed with regulators and manufacturers before, and his tough stance with Boeing fits that pattern. But the fact that this deal, the largest between the two companies, is now under threat raises serious questions. The exact reason Ryanair is reconsidering isn't clear. Rising costs, trade uncertainty, and ongoing doubts about the 737 MAX may all be factors. There's also speculation the airline is using this as leverage to negotiate better terms, either with Boeing or indirectly with regulators or governments. No cancellation has been confirmed, but the public nature of Ryanair's warning is already causing waves. If the deal falls apart, Boeing could lose not just plane sales but also long-term revenue from maintenance, training, and parts, key profit centers in the commercial aircraft business. Strategically, this loss would sting. Ryanair isn't just any customer. It's one of the largest 737 operators in the world, and its fleet is almost entirely Boeing. Losing that kind of loyalty could shift the balance of power in the industry and open doors for rivals, including Chinese manufacturers eager to break into the Western market. The broader context matters too. Airlines are still navigating high fuel prices, unpredictable demand, and supply chain issues. Big orders are now scrutinized more than ever, and flexibility is key. Ryanair's move could signal a wider trend, a warning to Boeing that customers want more for less, and fast. For Boeing, the stakes are high. In 2024, its commercial airplane division brought in about $23 billion. A $30 billion deal, even at discounted value, would have helped stabilize future earnings. These large orders are typically spread over several years, creating reliable revenue streams that support jobs, suppliers, and production planning. So far, Boeing hasn't said much publicly, but insiders report ongoing talks with multiple airline customers, aiming to keep deals intact and stay competitive. After recent setbacks, Boeing's under pressure to restore its image and rebuild trust. And now there's a new risk, that Ryanair's stance could inspire others. If one of Boeing's biggest buyers is ready to walk, what's stopping others from rethinking their deals? This isn't just about planes, it's about influence, strategy, and survival. A cancelled order of this scale could trigger ripple effects across the industry, affecting suppliers, workers, investors, and even trade relationships between the US and Europe. At its core, this dispute isn't just about aircraft. It's about the ecosystem of services, expectations, and long-term planning tied to major aviation deals. If Ryanair pulls out, Boeing isn't just losing a sale, it's potentially losing years of momentum. Ryanair's potential order of up to 300 Boeing 737 MAX jets would have provided Boeing with steady revenue for 5 to 8 years. Such large orders are usually fulfilled in phases, helping manufacturers stabilize cash flow and production planning. Losing this deal would hit Boeing's balance sheet hard, affecting projected earnings, investor sentiment, and operational efficiency. Even with industry-standard discounts, analysts estimated Boeing could earn $18 to $22 billion in revenue, with $5 to $7 billion in profit. More conservative forecasts still put net profit at $4 billion, a major loss in a tight-margin industry. But the impact goes beyond aircraft sales. Boeing also profits heavily from after-sales services, maintenance contracts, spare parts, pilot training, software updates, and more. These services often deliver steadier, higher-margin returns than the aircraft themselves. When an airline commits to a single aircraft type, these service deals tend to deepen. Ryanair operates a single-type fleet, making it a particularly valuable customer. If it backs out, Boeing would lose years of recurring service income. Production would also suffer. The 737 MAX remains Boeing's core product. Its production is tightly scheduled with suppliers and logistics partners. A disruption could lead to idle labor, surplus inventory, or penalties if deliveries to other customers are impacted. This comes as Boeing is still recovering from the 737 MAX grounding crisis, which cost billions and damaged its reputation. Supply chain issues, from engine shortages to titanium delays, continue to complicate deliveries. A lost order means less flexibility to manage these rising costs. Investors are watching closely. Big deals like Ryanair's are built into revenue forecasts and stock valuations. If the order is dropped, Boeing's outlook will have to be revised, possibly dragging its stock down by 5 to 10%, according to analysts. That would reflect more than just lost income. It would signal weakening momentum, especially as rival Airbus continues to land major contracts. Airbus's A320neo, the 737 MAX's main competitor, is gaining favor globally. Ryanair's potential withdrawal adds a political layer, too. Boeing is a major U.S. exporter, and losing a high-profile European client could inflame trade tensions, especially if linked to tariffs or regulatory friction between the U.S. and EU. These trade issues aren't new. Under the Trump administration, both sides imposed tariffs over subsidy disputes involving Boeing and Airbus. Some of those tariffs remain, raising costs for airlines like Ryanair and influencing purchase decisions. Ryanair could be using this moment to push back, not just on Boeing, but on the broader trade environment. Ryanair's threat to cancel its Boeing order could send shockwaves through Boeing's supply chain, risking layoffs, write-offs, and added storage costs. Suppliers on both sides of the Atlantic have already ramped up production in anticipation. The move reflects Ryanair's aggressive negotiation style. The airline often uses public pressure to secure better terms, whether on price, policy, or delivery. At the core are trade tensions, tariffs, and China's rising role in aviation. Ryanair has reportedly looked into China's COMAC C919, a potential rival to Boeing's 737 MAX and Airbus's A320. Backed by Beijing, the jet offers competitive specs at a lower price, but lacks EU certification, a process that could take years. Still, even suggesting a pivot to COMAC sends a clear message. It pressures Boeing and signals to US and EU policymakers that unresolved trade issues could open the door for a new competitor. That's no small threat. For decades, Boeing and Airbus have dominated the commercial jet market. A credible third option like COMAC could disrupt pricing, shift power, and reshape the industry, especially amid rising geopolitical tensions. For China, the C919 is a symbol of industrial ambition. A major order from Ryanair would be a milestone, marking China's entry onto the global aviation stage. Boeing, still recovering from the 737 MAX crisis, is in a vulnerable spot. Losing Ryanair, a top customer and a key player in Boeing's recovery, would shake confidence among regulators, investors, and other airlines. Ryanair also faces risks. Its low-cost model relies on a uniform fleet. Adopting a new, uncertified aircraft would bring major operational challenges, from pilot training to maintenance. This is bigger than one contract. It's about who controls the future of aviation. A Ryanair shift to China would challenge the Boeing-Airbus duopoly and deepen the link between aviation and geopolitics. Other airlines are watching. If Ryanair wins concessions, others, like EasyJet or Air France, might follow. Carriers are under pressure to cut costs amid fuel volatility, labor shortages, and post-pandemic recovery. For Boeing, every lost deal strains production lines, suppliers, and thousands of jobs. A $30 billion cancellation wouldn't just hurt the company, it could ripple across the U.S. economy. In the end, this is more than a business dispute. It's a battle over influence, competition, and the shifting balance in global aviation. This was just the beginning. Hit that subscribe button and buckle up. Digital Garage has so much more in store.